You're listening to The Road to Financial Independence by CPS Investment Advisors, where smart planning and sound strategy keep you steady as you grow.
And welcome back to another edition of The Road to Financial Independence. I'm the president of CPS Investment Advisors, Mike Riskin. And as always, I'm joined by my partner and CEO of CPS, Peter Galacco.
Hey, Mike, how you doing?
Terrific, Pete. How are you today?
I'm doing great.
All right. Well, it is July 2026.
It is after the second quarter.
After the second quarter, which means it's also the beginning of the third quarter. I know.
Absolutely.
It's CPA and me figured that out. And joining us for the start of the third quarter is our Chief Investment Officer from CPS, Pat Gauthier. Pat, welcome to the show.
Hey, Mike. Thanks for having me. Great to be here.
Do you have any math jokes to start the show with like I did, or are you...
I'll save them for the end.
Save them for the end? All right. Yeah, good choice.
All right.
Well, we are at the beginning of the third quarter 2026, which means it's time for a quarterly market update. And for those of you who joined us in Lakeland this week for our in-person meeting, thank you for coming. For those of you that couldn't make it, some of this is the same material. Hope you enjoy it. And if you have any follow-up questions or need any help with that, always call in to our office, 863-688-1725. We're happy to connect you with an advisor to help you out. So, looking back at the second quarter, looking forward to the third quarter, this year to date so far, we have a new Fed chair here. So that's been making the news. We have obviously the economies out there, what's going on with inflation, what's happening with the job market. The markets continue to hit all-time highs here and there. So the market itself is doing very well. We've had an IPO, a big IPO. But leading off, really, the headline has really been the conflict in Iran and oil prices. I think that's still on everybody's mind. So I think we should maybe lead off with oil, jump in there. So Pat, kind of what are you seeing with oil? And, has it been as much of a headwind as people were afraid of back in March and April when the conflict started, or have things kind of settled down a little bit right now?
That's a great question, Mike. And I think we talked about this earlier this morning, but the point of we're not in the 70s any longer. It's not the same oil market and the same situation here for the U.S. So, we'll throw some charts up, but we're looking at the fact that at this point, the U.S. is a net exporter of energy. First time we've been a net exporter of energy, and it's a great place to be when oil markets are doing what they're doing. And we can see that historically we've had higher oil prices than this, which is a good thing, that this time they're not quite as high. And ultimately, we're also in a situation where energy isn't quite as big a part of the budget for everyday consumers as it has been in the past. So you got
more electric cars, right?
Yeah, and we see them every day, more and more in the parking lot, right?
That's right. Yeah,
but cars are getting more fuel efficient. People are working from home; they're not driving as much. So yeah, I can see where that's becoming less and less part of the budget. But we're not consuming less oil.
No,
we're consuming more and more oil every year.
Right. But as a percentage of the economy, of how big the economy is right now, we'll get into some of those charts in a second. But I think you're right in terms of consumer behavior. A lot of time is driven by fear, and I think when this conflict first broke out, everyone went right to that early 70s playbook, like you said, gas lines, shortages, high gas prices. What's played out is it's clearly been a different story. That the oil supply is a lot more diverse than what it used to be. Certainly, being energy independent is a huge
and that's
deal
what
for
we've
the US.
been talking about that for years. That the U.S. is energy independent. A lot of this shouldn't affect us, but on a global market, that's what drives the prices. Even though we're energy independent and we're selling oil on the market, we're still having to pay global prices. But it wasn't as fearful as it was in Europe and other countries that don't produce oil.
That's a great point.
Where they didn't know where it was going to come from. And when the Straits of Hormuz closed, that was a panic point because a lot of oil comes out of there and people are depending on it to heat their houses, cooking, driving, flying, aircraft,
right,
military. So there's a lot of need for it. And when something like this happens, there's no doubt there's going to be some panic.
Right.
Well, you mentioned it last time after the last update, Pete. It's like panic and fear. When you hear those things out there in the headlines, it ends up being a pretty good buying opportunity.
Oh, absolutely.
That's right.
You always hindsight's always 20/20. Yep. But every panic that we've had along the way if you just bought during it, you've done very well.
Right. Yeah, and the next chart up, it just kind of just shows in graphic form since the 1970s, just what percentage of overall consumer spending is spent on oil, at least here in the United States, and you can see graphically that how sharply that's declined. So, you hate to think one concentration risk of one piece of the economy that could cripple productivity, and so it's good to see that that's kind of flattened out a little bit. The next slide really, one thing you and I talked about, and it was interesting to me, was I kept feeling every time there was an oil spike, it seemed like oil kept going like $3 to $5, and it just seemed like that, at least in Florida. Obviously, in some states it's higher because of taxes, but it just seemed that was the range. But it's been like that it seemed like for a couple of decades now. And so I was like, Pat, what's the real inflation number on gas? Because we've had inflation throughout the economy. So I would expect, like, if $1 of gas in 1990, I mean, gas should be like, $16 a gallon right now. Yeah. And so even though $4 or so is high, from an inflation adjusted number, it's really not that bad, right?
Yeah, in reality, when you adjust it for inflation, you're looking at $2 versus what we would have seen in 2008. So it still stinks to pull up to the pump and pay $4.50 at sometimes, depending on the gas you're putting in. But like we said, it's not that big of your part of your budget anymore. And when you look at it with all the inflation we've had, relatively speaking, we've had much higher gas prices in the past.
Just be thankful you don't have to fill up with a bottle of water. Bottles of water. I mean, they're going to pay a lot more per gallon
That's right.
for water than you do for
point.
gasoline. And you take a look at what it takes to get gasoline out of the ground and to the people, the cost and the type of work these people do. It's surprising that we can get it at $4 a gallon.
That is so true.
And even at $4 a gallon, there's a lot of taxes in there. So, all the states and the federal government tax gas. So if you remove that, the gas prices even go down further.
Yeah. And not just the demand is that the producers really try to get the price, control the supply a bit to get that price in that sweet range of that $70 to $90 barrel type range, because too cheap, obviously they're not making any money. Too expensive will at some point really drive the demand down. Consumers will overly respond, and so they can help with that price control as well.
And there's a reason why right now we're not in oil companies, is because the volatility is incredible. And what we saw, after the 2008, 2009, 2008, 2009, 2010, when oil, we started using less oil, bringing out more cheaper cars, demanding that cars have more miles per gallon, we started to see that kind of slough off a little bit.
Right.
So, and they started making less money.
No, that's exactly right.
Yeah.
So, and speaking of making less money, I think one of the big fears with higher gas prices is that corporate earnings were going to go down. It was going to be harder for the economy to move forward, and not just in this oil shock, so to speak, but historically. Is that what are we seeing right now, Pat? And what have we seen historically with high oil prices?
Yeah, I think if you polled the room and said, hey, oil is going to go up dramatically in consecutive days, historically what happens to the stock market, most people are going to say it goes down. And maybe for a short period of time it does. But when you fast forward a year from that point, historically it's up, and it's up significantly. Really the only time it hasn't been was mixed up in the mess in 2008, which really didn't have anything to do with oil to begin with.
Yep.
So it's counterintuitive, but as we've mentioned before, when the headlines are bad and people start to panic, that's a great buying opportunity. And oil is in everything we do in the economy, as you said, Pete. And you would think if it's much higher price, the price of everything is going to go up. And that may happen to some degree, but it really doesn't have that big of an effect on the stock market.
I think that would only happen if this oil crisis lasted a year and a half, where the prices were, $4 or $5 a gallon for a long period of time, because then they bake that into the goods. People have to make more money, therefore goods go up, and you start getting inflation. But as long as, and I don't think this thing in Iran is going to last that long. They don't have much of a military. They're just kind of a pain in the neck right now. But I think even though this is still going on, we're going to still see pressure on oil coming back down, because oil is flowing through the straits, not at the quantity that it was, but it's still flowing.
Right. No, absolutely. And you know, every crisis creates opportunity, and so I think this certainly was a wake up call for future oil transportation and countries doing different
Yes, it
things.
does. You're going to probably see a lot more pipelines and less transferring oil over the sea if they can avoid it.
Right. Be subjected to that. So moving on from the oil and the Iran conflict, talk about market fundamentals. I think that's something we always focus on, and we have a new Fed chair, relatively new at this point, right? A little over a month in the seat, Kevin Warsh. Talk to that a little bit. I mean, obviously, when we talk about the Fed chair, we're focusing on Fed fund rate, and that leads into the discussion of unemployment and inflation. So how are we doing in those areas? And what do you see from this Fed chair in terms of, you know, is he going to just come in and move rates, or kind of see how things are going to go? What's the take on that?
Yeah, I mean, another driver of headlines, right? There are a lot of politics involved this time around. You know, who's going to stay, who's going to go, who's it going to be? The reality is that it's a committee that makes these decisions, and they use data to make these decisions over the long term. And we can look back at the chart and say, okay, we've had a number of different Fed regimes out there. What's happened to markets in the new 10-year? And it's the same thing as an oil spike. You know, most of the time the market's going to continue to go up, and we'll get some Fed chairs in there that during their 10 years, something outside of their control happens. They have to jump in and fix it. And that's what we've seen with some of the data. But luckily, so far, we're up with this new Fed chair. They've had one meeting. You can't really expect a ton of changes after one meeting. But, you know, really the general feeling is that rates are pretty comfortable where they are now. You might see some tweaks. Probably not going to see wild swings outside of, you know, dramatic things in the economy. But the word is that they're going to be a little more focused on the balance sheet. And that's something that, you know, it gets into the weeds a little bit for everyday people. But you want to pay attention to what they're doing, whether it's increasing or decreasing, and the pace at which they do that. But, yeah, it's probably going to continue to drive the headlines, right, Pete? It's one of those things people love to talk about, but
it doesn't really affect us, though, the day-to-day people, because, you know, this affects the federal funds rate. It doesn't affect your mortgage rates.
No.
You know, so a lot of people say, oh, the rates are going down. Why is not the mortgage rates not going down? Right. Well, they don't quite go hand in hand.
And for a lot of our savers out there, we probably don't want the rates to go down much more than this. Really, I think there's kind of a sweet spot.
You remember when money markets were 0.25%? I mean, you're making some money right now on money markets.
You can make some money off a money market, and really, you know, if they did have to lower the rate, it would be because we've seen a spike maybe in unemployment, or
the economy starts slowing down. Right. We're starting to struggle a little bit, but right now it looks like it's still moving forward. A lot of money's being spent. A lot of money in business is being spent.
Adding jobs, unemployment's looking strong. It's no reason to lower rates at this point.
No. So talk about valuations as well. And you know, the markets, like we referenced, have hit some highs this year. A lot of people think, because now that it's at its high, it's destined for a drop, which is not necessarily the case. But talk about valuations, and is the market properly valued, or is this just euphoria and we're destined for a free fall soon?
Yeah, you've heard that a lot. You've heard the word bubble a lot this year, and you know, there's always the what goes up must come down. But you know, we entered the year and we spent most of the first quarter in what a lot of us would call overvalued or highly valued, if you will. And that just means that the price you're paying for $1 of earnings is higher than you've paid for it in the past. And there's two ways that you can correct that scenario. There's two levers to pull. There's the price or the earnings. Luckily, we've seen that the earnings are the lever that's being pulled at the moment. Earnings continue to increase, and that valuation is moving back towards normal, which is a good thing. We want to continue to see that happen. You know, you'll see less volatility as the earnings continue to grow. If it goes the other way and price is what corrects, that's where you run into issues. Luckily, we haven't seen that, and it doesn't look like that's coming. So much better value out there at the moment, and that's because companies are growing earnings, and it's not just the top of the market, it's the rest of the market. It's your healthcare, it's your pharmaceuticals, your industrials, your energy. You know, they're all growing earnings. They've got record profit margins, which we'll touch on, but you know, a strong market overall has caused the earnings to catch up with these lofty prices that we started the year with.
But we still do see a lot of risk in the market.
Certainly.
And usually when markets grow like this, people are comfortable adding risk.
Right.
you got to be careful how much risk you add. And so some of the more riskier investments the past couple of years have grown the most, which means that you could be a little bit out of whack in your portfolio with more risk than you really want to going forward.
Right.
It's all about how money's being spent. And if we're slowing down a little bit, you got to be careful with the investments that are going on out there. So, look at your risk. That's one of the most important things.
Absolutely.
Yeah, and so we usually don't, just shifting gears a little bit, we usually don't talk about specific stocks on the podcast, but we are going to hit on one real quick, and not necessarily.
And this is not a recommendation to
not
buy
a
or sell
correct.
or anything like that.
That's right. And the conversation is really going to be more around the theme of IPOs, not necessarily this stock in particular, but we are going to talk about the stock because of the over or the hyped, I guess to be determined over or under hyped back in June. But SpaceX IPO'd back in June. We got a ton of phone calls about it. Talk a little bit about IPOs, Pat, why a lot of these fall flat out of the gate. They might be incredible investments down the road, but what happens in an IPO? And people are so obsessed with the IPO price, but who's really making the so-called early money here? Is it the IPO price people, or who might it be? And then why might you be uber careful in those first few months of trading during the euphoria?
Yeah, it's a great point. I mean, when you think about what is an IPO, it's initial public offering. It's the first time that these companies are offering their shares for general public investment. And so why do they do that, really? These are companies that have been in business for a while. Some are profitable, some are not. But they do that historically for financing. So you'll see on the chart there's a number of very well-known companies there that are very successful companies. But they went public because they needed access to equity, lower cost equity. Mm-hmm. And in the case of today's IPOs, this new wave of IPOs, these are companies that don't need the money, essentially. They've been funded for years out of private equity, private debt funds, private capital flowing to them. And, if you're a SpaceX or OpenAI or Anthropic or whoever's coming out next, you can get money from anywhere you want without going public. And to speak on SpaceX for a moment, we all are well aware of who Elon Musk is and his affinity for saying whatever he wants, whenever he wants. And so if he had to choose, I'm sure he wouldn't want the scrutiny of being a publicly traded company. He wants to be at the reins and do his thing the way he wants to do it. Mm-hmm. So when I look at this, going public is a status thing. You get to be involved in the indices and be a big name out there on the market, on TV every day. But it's also a way for your early investors to cash out. These large companies, these private funds that funded you when you were a startup, now that you're years into your business and it's a viable business, they want their money back. They want to get that rate of return that they took on early on in investing. Yep. So as individual investors and clients that we've talked to over the last few weeks, it's very exciting. You want to be part of an IPO. You want to own some SpaceX. Could be a great business long term. We don't know.
It would. And, I don't think we should bet against Elon Musk.
No.
Right.
I mean, he's proven to be a winner in just about everything he touches. Yep. But when you're investing your money, you really got to take a look at what you're doing. Yeah, I think SpaceX is going to be like an Apple. Apple didn't make any money for the longest time, and then all of a sudden, boom, they exploded. Yeah. And if you take a look at when SpaceX came out, the market cap they sold at was $1.77 trillion.
Right.
In 2025, they lost $2.6 billion.
Yeah, there's a little bit of a disconnect there.
So if you take, not a recommendation to buy or sell, but if you take Walmart market cap is $887 billion, which is quite a bit less than SpaceX, and they made $19.4 billion in profit.
Right. Yeah.
So when you have a guy who's really successful, you're investing in the guy, but understand that you're not going to miss out on this opportunity. It's going to take a little while for this to come along. And to be perfectly honest with you, I think he's going to buy back the SpaceX stock eventually, because I don't think he wants to be in the public market. I think he's going to use that money to own AI and make the other ones go away. I wouldn't put it past him.
Yeah, and I think bringing this up again, it just because we've been getting a lot of questions about IPOs, SpaceX, and because also we're going to probably see a couple more, like you referenced, Pat, a couple more this year, big name ones. It's really matching up the price of the stock to the value. What's the true value, and not buying into that hype when it first comes out. There'll be a good opportunities to get into these companies. We just maybe don't recommend getting into them when they're insanely overvalued.
I agree, and you take a look at some of the big AI companies, not the ones that have business elsewhere, but all of their revenue is coming from companies like Apple and Microsoft and Google and Amazon. What if that revenue starts to slide a little bit? What if they think that, this AI hasn't taken off as quick, maybe cut down on a little bit of our capital investing? That could create a problem for these type of companies.
Right. No, absolutely.
So a lot of risk out there. A lot of risk.
Well, good segue into AI, and I think that's another topic du jour, or topic of the du jour, but I don't know my French, but it's a hot topic for the year here. AI spending. Speaking of AI spending, I think we got a great chart here. What does that look like? Where are companies spending in this space, and what's the outlook on AI at this point?
Yeah, Pete hit it right on the head. There's a lot of money flowing through these companies. Luckily, what makes it different from previous tech run-ups or bubbles, if you will, is that it's coming from companies that are generating cash flow. These are the biggest, most profitable companies in the world, and they're now shoveling a lot of those profits towards AI.
And if it doesn't work, they won't feel it.
That's right.
Yeah.
They won't feel it. But
Absolutely.
the ones that will feel it are the ones that were down on the bottom of the S&P 500 6 years ago, now are leading it. That they're depending on this revenue stream, and it's a lot of risk.
Yeah, because you never you don't know who's going to be the winner, so to speak, at the end of the day. And so just like the .com bust, where you just put .com next to anything and it went up, you attach AI to anything these days and it goes up. So you just, word of caution of the quality, look for quality over name in this case, right?
Yeah, there's a difference between a business needing AI to work to stay alive versus some of the big names. If AI disappears, they still have this underlying fundamental business, which are the best businesses in the world.
That makes a lot of money that they can afford to do that without any issues.
Absolutely. Yep. So where are we seeing? So we are seeing some investment in the AI space and some of these different AI agents, so to speak, and all these different industries are adapting to AI at different rates. Correct? Different industries.
Yeah, and we've seen it, obviously information and research and finance is taking the lead. That's where it's most easily implemented early on. And we see there that the models keep getting better and better, which hopefully means that they'll get more use cases throughout the rest of the economy. But, there's a lot of fear about, is AI going to take over everyone's job? Are we all going to sit on the couch all day? And the reality is there's things you have to do out there in the physical world that AI just can't do. And you're seeing it there on the chart that it can't go build something for you yet in the real world. It's not going to go out there and build a factory or build houses for you. So
it's not going to grow food for you. It's not going to cook the food for you.
And even in those industries where it's service industries and human capital, I still have a firm belief that personal relationship is uber important. That'll still continue, and that AI is going to be much like the computer, much like the internet. It'll be a
tool that we can use,
an enhancing tool, a productivity enhancer, and so it might reshape business and industry. Certainly will, as the big fear of being a job eliminator. Hopefully, it does not come to fruition, but I can definitely see it being more of a tool than a replacement.
And they'll replace some jobs. I think it can code. There might be some admin jobs that might be replaced because of how it works. But really, what I think is going to happen is you're going to have a PhD in your pocket. Whenever you want to know something, regardless what it is, you're going to ask it, and it's going to give it to you. If you want to design something, it's going to do that for you. But if you want to design your backyard, it'll design it for you, but it can't put anything in there.
Right. Well, you also, I could have that do it. You still have to know what you're doing. So, I could design, maybe I could go online and design my backyard with AI, but, I'm still going to go call an architect
you're going to have
engineer and be like, hey, right? Or, you could go down any industry and say, so is one, I could look online about my medical condition, but I'm going to go see a doctor, right? So I think it's going to be an enhancing tool for they're still going to need the professionals that understand the information.
AI is not going to be able to prescribe you your medicine I don't think it will. I don't know, maybe one day, but I
I still want to talk to somebody.
That's right. That's right.
That's me. All right. Well, moving on from AI, there's talk about this K economy and consumer with a K. What does that necessarily mean? And it seems like there's two economies out there right now. Sort of have the folks that seem to be doing well. Their homes are at record values. Their portfolios are at record values.
Rates on their mortgages
Interest
are
rates
really low.
are super low. Yep.
Still a lot of those.
And then you have maybe the folks that are just starting out, that don't own a home, are just starting to save.
Interest rates are
Interest
up.
rates are
costs
high.
are up.
Right.
Markets up.
Markets are up. So they're feeling a different economy than those other folks. So kind of explain that K-shaped economy. What are we looking at?
Yeah, and it's funny, when we picture a K, we picture a 50-50 split, the upper and the lower. But as we're showing on the charts, it's actually quite a bit different than that. The top 40% of the income earners are driving most of the spending in the country. And some of that has to do with the things you mentioned. If you're more established in life, you've got that low locked-in mortgage rate, your house is worth a ton, you've been saving for a while, the markets have been going crazy for a couple years, you feel pretty good. The sentiment is high in that category. But for the lower end of the spectrum, the sentiment isn't quite as high. They don't feel as great when they're at the gas pump and it's $4. They don't feel as great when the company they work for has record profit margins, but their income hasn't increased over the last few years to keep up with that. So that's where we see that split. There's a group of folks who are really keeping the economy going at the top, and we see that. You talk about traveling all the time. If you're out to dinner on a Thursday night and it's busy, that's a good economy.
Yep.
I've been traveling for a couple weeks and the planes are full. No extra legroom seats available, right?
No.
You can't get an upgrade if you want it.
It's tough, yeah.
So there are two avenues in the economy here, and you want to help out those people on the lower end as best we can as a society, but the folks on the upper end are still willing to spend. They're out there spending, and that's what's driving profits in the S&P 500, and that's why the economy is still growing and there's still jobs added out there.
And this chart on the upper right-hand side proves a point that I say all the time. The bottom 60% of Americans spend more than they bring in. So they make 100, they spend 120.
Yeah.
And that's just the way it's always been, and it's the way it's going to be.
Yeah. And really, when we say lower end, in a sense, it's not even we're not even talking like even the poverty level in the sense, or these are new folks new to the economy, so new job, your graduates, even your 30, 35-year-olds just starting a family. Very difficult to buy that first house, to keep up with the cost of goods from inflation. So they might be making decent money, but struggling a little bit right now
to afford stuff,
to save. Yeah.
Well, I mean, you look back 4 or 5 years. In the past 4 or 5 years, our inflation's gone up 25%.
Right. We've never seen that before.
I mean, it's
in our
killing people, absolutely killing people, and that's taxation without representation.
Yeah.
So
the silent tax. Consumer finance. So when we look at the economy and try to predict, is the market, how's the market going to do the second half of the year and those types of things, we definitely look at the condition of our consumer, because the economy drives on, and like you said, Pete says this all the time, the velocity of money. So we do need people to be making money and spending the money. And
I think everybody needs to go in substantial debt, except for the people listening to this podcast.
That's right.
You need to save money, make money off those people.
Let the other people make you money.
That's right.
But how are there flags out there where maybe people are overspending and all of a sudden we're going to see everyone put on the brakes? Or what's the balance sheet look like of your average U.S. consumer?
Sure. Well, fortunately, it's relatively strong. You can see that there are assets on the balance sheet and far less liabilities. And the interesting thing we see on that chart is that, it's still, your home is a significant part of your asset, and that's going to be important long term. But as we've seen this chart change over the years, the other financial assets part, that big chunk on the bottom there, is growing, and that's the asset owners, 401ks, the people investing in brokerage accounts, and we're more and more becoming, that's how you're going to get ahead. It's not buy a home and pay it off after 30 years. It's be an investor, be an owner of assets in the market. And the other two are just going to show us that, we're doing pretty good on the side of debt. We have a debt service ratio that's as low as it's been outside of COVID in a long time. And then folks are figuring out ways to pay off these debts they're taking on. And I think that is going to prove out that K-shaped economy, is that some folks on the lower income spectrum are going to start to struggle with debts a little bit. But even when we see student loans being switched back on, people figured out how to make that payment. Everyone thought that was going to be a cliff,
Right.
Well, it went up real quick. Now it's starting to come back down. But one thing that I find interesting, and I heard a speaker recently talk about the household debt, and the chart started in 2015. And when he showed it, it looked like, in 2025, 2026 at 11.1%, we're getting up there to the peak. But if you look at history back to 1980,
Right.
we're not even close to it. We're not even close to what it was in the 80s. So household debt is not out of whack
Right.
historically.
Yeah.
So, and it does have room that could rise before the problems can happen. And I like to see the fact that student loans are coming down.
Yeah.
That's important. People paying their debts off.
Yeah, I know that's been a big source of conversation in this country the last few years with the rising cost of education and those types of things. So last little segment here, moving forward, some of the things that we focus on. Let's talk about just the market in general, and time kind of heals all volatility, so to speak, in the stock market. What is stock market? It's going to go up, it's going to go down day to day, week to week, but how should investors look at the market as a whole?
Yeah, we want to look at it over the long term. And I know you preach this on a regular basis, but we're investors for the long term, as all of our clients are. And we're going to talk about this every quarter. And when we were talking about it last quarter, the market was down a little bit. We're talking about it now, the market is much healthier. But any short time frame, as the chart shows, it's going to be volatile. You don't know what's going to happen tomorrow or next quarter or next year. But if you just move out 5 years, you have a pretty good understanding that the market can grow, barring a significant issue. Take that out 10 to 20 years, and you're not guaranteed, of course, but you
got a pretty good
You're pretty
idea
sure
that you're going to make some money.
Yeah.
As long as you buy the right stuff, you're not too aggressive. And Warren Buffett always said that if his clients would just close their eyes for 10 years, they'd be rich beyond their wildest dreams. But they buy and sell all the time, and they ruin their returns.
And they do it, and they do it at the wrong time.
wrong
And I
time.
think this next chart kind of proves that out. And it sort of shows that everyone wants to buy when the markets are up, and everyone wants to sell when it's going down. And so, Pat, we talked about this morning. You sort of made the reference of the smart money of the professionals, the ones with the fiduciary responsibility versus your individual investor who's sort of more of an emotional investor.
Yeah. And everybody wants, it's exciting when the market's going up, and you don't want to miss out. It's called the fear of missing out. We call it FOMO.
FOMO, yeah.
So everybody wants to get in. You want to get this because people are making, your neighbors making money and all that. When in reality, you're chasing something you shouldn't. And it's hard to do, but what you should be doing is when people are chasing the stock market, you sell into it. When people are running away from it, you buy into it. And that's how people build wealth.
That's right. Yeah. So kind of, and I think what we're just, we're not necessarily saying sell when it's up, but diversify, make sure you're properly allocated. Don't just ride the wave and close your eyes because,
Make sure you have some durable products
some
in there that,
right.
you got to spend your money, there. Yeah.
But Pat, go over this chart a little bit. I just think it's an interesting, conversation on consumer behavior a little bit and what we're seeing in terms of flows in the market.
You hit it right on the head. It's the smart money versus the rest of us, right? So on the left, you're seeing those defined benefit plans. Your grandpa's pension, your retirement systems are out there, and they're roughly 60-40 historically, because that's the right amount of risk for them to take to meet their obligations and hit their goals. When you look at the second column in that chart, you're looking at, okay, even now with the market running up, they're a little less than that. They're more 50-50. So they're saying, okay, we've made some money. We don't need to take as much risk right now the way things look in the market.
Yep.
Move that on to the consumer, or the people with the 401ks. Yeah, it gets a little crazy.
Trying to keep up with the cubicle next door.
That's right.
So where there are typically more stocks historically, they're even more so now with the market running up over the last couple of years. And what this tells me is that folks aren't as quick to review their portfolio, review the type of risk they're
Not
taking.
when it's going up like this.
Not when it's going, they don't FOMO. They don't want to miss out on it. So I would encourage everyone to review the risks they're taking, and you don't need to take all the risk that's available out there to hit your financial goals. Take what's appropriate and take the W.
Yeah, absolutely. And something that these investors in these 401ks don't realize is if you look at all the funds, the stock funds out there, the top 5 or 10 are the same companies in all of the funds. and there's a lot of risk at that top. So
A very big concentration right now.
big concentration, even the S&P 500,
Very concentrated.
huge concentration, which is dangerous. So you got to make sure you're blending in some assets that don't follow this risk.
Right. Right.
So
No.
and that's why you see this green continue to go up. They're okay with that risk until it comes down.
Right.
That's when your 401k turns into a 201k and everybody complains.
That's right.
Oh, yeah.
And, yep. And they'll be selling on the way down.
That's right. That's right.
So yeah, and so that's a great overview there. Kind of hit on all the hot button topics, so to speak, of Q2 heading into Q3. I love this chart. There's always a reason not to buy stocks. I don't see 2026 on here, so if we can impromptuly write 2026, what does that look like in terms of why should we not buy stocks in 2026? What's the crisis that we've gone through, and maybe what kind of headwinds should we look ahead in terms of headline makers?
Well, of course, the Iran war is a big one.
That would be the big one.
Yeah,
Yep.
I mean, when we bombed Iran, everybody thought the whole world shut down. We don't even do business with Iran, let alone, I mean, our economy, I didn't get it, but that's what happens. You look at all of these items from 2000 to 2025, and they're all headlines. They're all emotional.
Yep. Fear
mongering. And if you really study this and you go back to 2000 and you look through and find out when we first started to talk about the political scene,
Right.
we never talked about the political scene because we didn't care. It didn't affect our economy. Well, emotions affect it. And in 2016, you'll see the Brexit vote, which was a political thing, which didn't really do a whole lot of anything, and the U.S. election. Why? Because President Trump got elected. Now, politics comes into a lot of people's decisions. We need to stop that as a country because we have a free market here.
Right.
We make the decisions on what we spend and how we spend. And if we let these politicians scare us into not spending money, yeah, we're going to go into a recession.
Yeah.
But if you can go outside, you're living your life and you got money to spend, enjoy your life. Turn the TV off. Don't listen to these. I wouldn't let any of these people even balance my checkbook, let alone tell me what to do with my money.
Right.
But we got into a society where, we believe that stuff is real. Well, it's not real. I mean, we've had presidents, my whole life, we've had presidents that could have done a lot of damage to this country, but they didn't. Why? Because they don't have the power to.
Right.
So politics needs to come out of our investing and the way we look at the economy.
Right.
It's us, not them.
But it's certainly a headline maker, and
It
sort
is.
of second half of the year we do have midterms.
Yeah, and I
coming
just
up.
said that, but we have midterms coming up, and guess what's going to happen? The mud's going to
It's gonna be a lot of mudslinging.
and we're going to get some volatility. When in reality, we got to take a look at what's going on in the economy. What's going on with the companies?
Right.
What's going on? How are people spending money? And turn that TV out. Who cares about that stuff?
Yeah. But would you say, September, October, before an election, midterms or presidential election, kind of see a little more volatility, and then once the election's over, things kind of settle down? Is that kind of what we see typically?
I would expect it. Yeah, the mud's going to fly. There's going to be more headlines,
A lot of negativity, right?
a lot of negativity.
Markets do
Buckle up.
not like uncertainty.
Right, right.
They do not like uncertainty. And it doesn't matter who gets in, as long as they're certain who gets in.
Right.
We know how to make money regardless of what political party's in. We can make money. We just need to know
That's right.
what rules we got to play by.
What are the rules of the game going to be?
Exactly.
All right. Well, Pat, appreciate you stopping by.
Thanks for having me. This is great.
These are obviously recorded, so next quarter we're going to come back and see if all your predictions are correct.
Yep.
And hold you accountable, and we'll do it again next quarter. Appreciate you stopping and being on the podcast.
Thanks for having me. It's a great time.
The Road to Financial Independence, once a month. Follow on Spotify, Apple, or wherever you listen. And subscribe on YouTube at CPS Investment Advisors. Visit us for more information at www.cpsinvest.com. The information provided in this podcast is for informational and educational purposes only and should not be construed as investment, legal, or tax advice. CPS Investment Advisor is a registered investment advisor with the U.S. Securities and Exchange Commission. Registration does not imply any level of skill or training. The opinions expressed on this podcast are those of the host and guests and do not necessarily reflect the views of CPS Investment Advisors. The information discussed is believed to be accurate at the time of recording, but may not remain possible loss of principal. Past performance is not indicative of future results. Before making any investment decisions, listeners should consult with a qualified professional about their individual circumstances. For additional information about CPS Investment Advisors, including our services and fees, please review our Form ADV, which is available at www.advisorinfo.sec.gov.